Good evening and welcome to the final session of our Money webinar series this term by the Institute of International Monetary Research in collaboration with the Vinson Center at the University of Buckingham. I'm Dr. Juan Castañeda, Director of the IIMR, and tonight I will be hosting Gabriel Stein. Gabriel is an independent macroeconomic commentator and forecaster. In 1980, he graduated from Stockholm School of Economics. 1 year later, he worked at the Israeli Ministry of Finance International Relations Department. From 1982 to 1990, he ran Stein Brothers, a public affairs and economics research consultancy, first based in Sweden and then from 1990 in the UK. From 1981 to 2012, he was chief international economist of Lombard Odier Research, where he helped set up the company's World Service. After 2012, he has worked in different senior positions for Stein Brothers in the UK, Oxford Economics, and Forecast RGE. He is a senior fellow of the Adam Smith Institute and has collaborated with several universities in the UK and abroad, including Royal Holloway University of London, Warwick University, the University of Buckingham, and Cardiff Business School, among others. And since 2019, he has been an associate lecturer at St. Mary's University in Twickenham. He's a member of the Academic Advisory Council of the Institute of International Monetary Research, of the IIMR Money Data Advisory Board, and a non-staff economic advisor to the Bank of Mongolia Education, Research and Training Institute. But not all is about economics in Gabriel's academic and professional life. Gabriel has an MA in military history from Buckingham University and has published 3 historical novels and a non-fiction book on Sweden and the Crimean War. Gabriel Stein will discuss today macroeconomic forecasting and inflation leading indicators, 2021-2022, after which we allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel in the next few days. Questions must be submitted via the chat option, and I will moderate them and address the speaker. This is the final session of our Money webinar series in the winter term, which will be continued in the spring with more speakers and more topics on money, banking, and central banking. We'll be restarting the series with John Greenwood on the 14th of April. You will find more information very soon on the Institute's website and the forthcoming events. So without further ado, Gabriel, it is a pleasure to have you with us tonight. Thank you very much for collaborating once again with us, and the floor is entirely yours. Thank you.
Thank you very much, Juan. I'd like to thank the University of Buckingham and the IIMR for asking me to do this talk, and all of you for listening, of course. This talk is called the Economic and Inflation Outlook for 2021 and 2022, but actually it consists of 2 parts. One is an introduction to economic forecasting, and the second is the actual outlook. I know that the audience is mixed, but I should say that I have pitched the economic forecasting introduction to the student level, which I'm afraid means a lot of the professionals watching will already know what I'm talking about. So beginning with an introduction to economic forecasting, there are 2 basic principles underlying all forecasts. The first is that the future is like the past, and the second is that the future is not like the past. Or to put it slightly differently, either there's nothing new under the sun, as Ecclesiastes famously puts it, or else there are lots of new things under the sun. How do we make sense of this? Well, of course, the future has to be grounded in the past. That being said, the future will of course be different from the past, but the starting point is always that it won't be. When you're attempting to forecast something, there are essentially 2 ways of doing it. One is point forecasts. These are the ones you encounter frequently in news media, where people say that GDP growth will be X or non-farm payrolls will be Y. Point forecasts are almost invariably wrong. they're definitely wrong if they are very detailed and you got one, let alone two numbers after the decimal point. When you see any point forecast, you should probably ignore anything that's to the right of the decimal point. Nevertheless, point forecasts can be important and useful for indicating a directional trend. In my career as a forecaster, I have found that much better than point forecasts are relative forecasts. Relative forecasts are, of course, non-specific, but they give you, in my opinion, a better picture of where you're heading, and they can above all be used for spotting turning points. Now, there are different types of economic indicators that we look at. Economic indicators are, of course, time series that have historically shown themselves to be reliably correlated with economic activity. And the three types that we have are lagging indicators, where have we been, coincident indicators, which tell us where we are, and leading indicators, which tell us where we will be. Looking at these somewhat more closely, lagging indicators, typical lagging indicators are labor markets data and GDP data. GDP data because it's published 1, 2, or 3 months after the quarter they refer to. Labor markets data because, of course, labor market data tells us what employers did last month or the month before based on what they thought would happen 1 or 2 months before that. That actually makes it rather ironic that the possibly biggest market moving data point every month currently, and this has been the case for years, is in fact labor market data. It's the US non-farm payrolls. And what makes it even stranger that we use the non-farm payrolls as such an important indicator is that not only are they lagging, but whatever number we are given 1 month will be revised probably by a double-digit percentage, not only the next month, but the month after that, and in a random direction as well. However, there's no accounting for market behavior sometimes. In terms of coincident indicators, the ones that are the most common are retail sales and industrial production. However, what should concern us here is more likely leading indicators. And leading indicators come in a number of different fashions. The most important, in my opinion, are the monetary indicators, above all broad money, but also interest rates. Other important leading indicators are household spending indicators, and the two biggest ticket items that households tend to spend money on are cars and housing, and usually their spending here will show up in the money data as well, because usually households need to borrow to buy cars or to buy houses, and while there's always someone who needs to replace a car or needs to move, generally speaking, you will not borrow money unless you feel confident that you will be able to repay it. So household spending is also an indicator of the state of consumer confidence. You have a number of business indicators, above all, to my mind, business surveys. Any businessman worth his salt will know almost, I almost said to the last decimal, how much his company will produce over the next 1, 2, or 3 months. Certainly so compared with what the normal situation is. They will have a good eye for what their order stock is, and above all, they will have a good eye for their inventory of finished goods. There are also harder data such as inventory to shipments ratio, which are important. You will notice that most of these business indicators that I talk about are related to manufacturing. That may sound a little bit strange, since manufacturing is a fairly small share of the overall economy in any advanced country. In Britain, I think manufacturing is about 20% of the economy. Similarly, in the US, in Germany, it's a bit more, and so on. But manufacturing is much more sensitive to the business cycle, much more volatile than services, and approximately 40% of the service sector in each economy actually consists of services to manufacturing. So the concentration on manufacturing on business indicators is still valid. However, I should say that when it comes to business service, there are now many more business services that look at the service sector than there was 30, 20, or even 10 years ago. The forecasting horizon for leading indicators varies substantially. Business surveys probably look about 3 to 6 months ahead. By contrast, monetary indicators probably have a horizon of between 12 and 18 months. Is it possible to forecast further ahead than 18 months, 2 years, perhaps more? Well, the further out you attempt to forecast, the more fraught your forecast is. And the more important it is, of course, to be aware that things can change. And as we have certainly seen in 2020 and 2021, change very rapidly indeed. Okay, this was a very, very brief introduction to economic forecasting. Now let's look, by using some of these indicators, let's look at the outlook for 2021 and 2022. And I will concentrate on the US economy, not exclusively, but I will do so because the US is still the largest economy in the world. It is therefore the most important one, and because the US tends to be ahead in the business cycle. Among the many sayings that you will encounter in economics, for instance, is that Germany pulls the rest of Europe along with it, for instance. That's generally not true. Germany usually lags the business cycle of the rest of Europe, and so on. Like I said, the US tends to be ahead of the world. So let's look at what's happening in the United States and referring back to these indicators. This chart here shows US building permits. Building permits are not given as much publicity as the more common housing starts, but to my mind they are a better leading indicator simply because building permits lead housing starts. So they are an earlier indicator. And what we can see here is that building permits are surging, and they are actually at a level now which they have not seen since before the Great Recession, or the outbreak of the Great Recession in 2007, 2008. That is therefore a very bullish leading indicator. Looking at US inventories, this is the inventories to sales ratio. Bear in mind, of course, that a low inventories to sales ratio is a bullish sign because it means that manufacturing or industrial output will increase if we assume that companies have a sort of long run average target. Again, this is a reasonably bullish indicator. Inventories to shipments, the inventories to shipments ratio is not as low as it was in the years just before the Great Recession, nor as low as it was in the early years of the past decade. But I actually think that that's slightly misleading because one of the consequences we are likely to see of the pandemic and of the trade wars that took place, above all during the administration of President Trump, is that the just-in-time inventory levels that became all the rage in the 80s, 90s and noughties are going to shift back, and companies are going to hold slightly higher levels of inventories. I could be wrong on this, but if I'm right, then this is again a bullish indicator. And I should, since I'm talking here about things that may be different, I should mention one more thing, which I think is important. I started saying that the basis of economic forecasting is that the future is like the past. And in fact, when people start telling you this time it's different, it's usually a sell sign, because it's very rare that things really are different. And it's usually, the expression is usually used to inveigle you to invest in something unproven. However, I would say that this time the outlook really is different. There has been no global pandemic in 100 years, and that means that the baseline for all forecasts is completely thrown. And in turn, that means that some indicators that we have seen over the past 12 months are probably not as relevant as they were in the past. Things like car sales and house sales, for instance. If people are locked down, they don't feel the need to buy cars or to move to the same extent. However, I should say that other indicators, such as business, service and money, are almost certainly even more relevant than the past. Let me also say here that from time to time you have encountered media saying that following the pandemic, we all realize that we are in it together and basically we will become nicer people. I don't believe that. And traumas like a pandemic or like a war don't make people nicer and more caring. In fact, it makes them want to enjoy themselves the more when the traumas are over. Hence the roaring 20s in the United States and the rest of much of the advanced world 100 years ago. And I think we're likely to see that the coming decade will also be one of roaring 20s. And part of that is because we've had a period of more than a year with artificially suppressed demand, notably in sectors like hospitality and travel. And if normality returns, these sectors are going to bounce back probably quite strongly. At the same time, of course, we're going to see new players. So moving back to the charts after that slight digression, as I said, this is another bullish sign. What about sentiment? This shows the US University of Michigan Consumer Sentiment Index and personal consumption expenditure spending, the broadest gauge of US consumer spending. Reasonably well correlated, as you can see. At the moment, the red line, the consumer sentiment is improving slightly. It is not strong by historic standards. It's probably around average, but latest numbers have generally been stronger than expected, and that is also a bullish sign. Finally here, or not finally because there are a few more slides, we can see that although PCE, personal consumption expenditure, inflation remains subdued, that's the red line. Inflation expectations are rising, both the University of Michigan Consumer Survey and, perhaps more importantly, the Institute of Supply Managers Index for prices paid in manufacturing. It's not a record high, and it is a volatile number, but it is very high, so by historic standards. So for the US, what we're seeing is the indicators that we can probably rely on are quite bullish, both for activity and for inflation. Shifting to the euro area and in the UK, what we can see, and I'm only going to show two indicators here, are that inventory perceptions in the euro area are quite low. If you look at the bottom row in each column, that shows the latest the answers to the latest question of how do manufacturers perceive their inventories relative to normal. So the balance of manufacturers perceiving them to be excessive is quite low by historic standards, low by relative to average. Not as much in Spain and the UK, possibly in the UK because we've had a much longer lockdown. But again, this is a bullish sign. It implies that industrial production is going to increase. And finally, if we look at selling price expectations in the euro area, and I'm using Germany specifically as an example here, we can see again there's been quite a marked progression from March, April and May last year, when manufacturers perceived that their prices would have to fall back, and that inflation would be, or that deflation probably would be exacerbated to where we stand at the moment, and this is likely to continue to increase. Finally, I'd like to talk a little bit about broad money, and perhaps more than a little bit. Let me begin by saying one thing. Very few central banks, not any of the major central banks, pay any importance to broad money anymore. They tend to look at credit instead. Well, if you look at credit data has generally been quite weak. This is a mistake on behalf of central banks, and it's a mistake for two reasons. The first is that credit is a once-off. You create a loan and that's that. But money, when created, lasts almost forever. There are in fact only two ways you can destroy money. One of them is by paying down bank debt, and the other is by buying newly issued bank shares from the issuer. There's no other way to destroy money. So excess money exists, and it goes around like a hot potato, passed from one to the other. And secondly, what the pandemic has shown us, and it's not the first such episode historically, but it's a timely reminder, is that money can grow without credit growing. Now, normally that shouldn't happen. Credit is the bulk of the assets of the banking system, and money is the bulk of the liabilities of the banking system. But if the state creates money and gives it to the non-bank private sector, households and companies, by crediting their bank accounts or sending them checks, as the US does in its strangely primitive way, and people then deposit those checks in their bank accounts, then money can grow perfectly well without credit growing. And it's money that is the leading indicator of inflation or of activity, and of activity. And so what we have at the moment, what we can see is that although broad money growth slowed in late 2020, these numbers, although they look strong, are much lower than the numbers we saw in the summer. With the exception of China, broad money in the major economies remains well above levels consistent with trend rate growth. That's true in Japan as well. It may look like an outlier on this slide where we see Japanese broad money growth at 7.5%. But believe me, that's about a 20 or 25-year high. The normal number for Japan in the past decades has been 3 or 4% per annum. Moreover, it's not just that broad money growth remains high. If you look at the bottom part of the slide, which shows 3-month annualized rates of growth, which is a better guide to recent trends, we can see an acceleration in broad money growth again in the United States, in the euro area, significantly in China in the last month, although be wary because this may be related to the fact that this was the run-up to the Lunar New Year, of course. And also there's been an acceleration in the UK, not so much in Japan, where money growth is stable or even easing. In addition, loose monetary policies will continue. We have just seen the chairman of the Federal Reserve making very clear that he is not interested in raising rates, not to mention that he's already said in the past that they will accept above target inflation. There is little reason to expect that money growth will slow very sharply in coming months. And that means that we still have this huge wall of money that was built up during 2020 and early 2021. And this money, which is, if you want, excess money, it needs to find a home. Money must always find a home. And unless the demand to hold money in the form of money, i.e. as a bank account or cash, is infinitely elastic, then at some stage, the non-bank private sector, households and non-financial companies, will start spending, and money has to go somewhere. And money can only go to 2 things, 3 actually. It can either go into assets and create asset price inflation, and we have of course seen substantial asset price inflation during 2020 and even now in 2021, or it will go into goods and services, and that creates consumer price inflation. And that's what we are seeing in the indicators, that this is beginning to happen. Now, at the moment, inflation is actually still subdued. The US Consumer Price Index, both headline and core, was 1.4% in the year to January. In the euro area, it was 0.9% in January for the headline, 1.4% for the core rate. It's even lower in the UK. Surely I'm exaggerating here. Inflation isn't a problem. And in fact, inflation is below target everywhere. Don't central banks want to bring it up? Yes, they do. Central banks do want inflation. And I might add, governments will want inflation as well. Governments have borrowed massively to combat the pandemic. That was the right thing to do. But they have borrowed on a time-limited basis. I don't know why they didn't issue perpetual bonds, but that's another discussion. They've borrowed on a time-limited basis. They will have to roll over this debt. Interest rates are likely to be higher, and so a year or 2 of inflation, let's say in the 5% range, would be very much welcomed by governments to bring down the real burden of the debt. Moreover, there are 3 reasons, I think, to believe that we will see higher inflation. First of all, there's the base effect. As the deflation or disinflation numbers of last year drop out of the comparison, 12-month rates will jump. Second, it's not just governments that want an overshoot. Central banks want it as well. That's this American policy of average inflation targeting. So we are unlikely to stop at the notional inflation targets, even if we reach them. And third, and that's perhaps not a reason to expect inflation, it's more reason for forecasters and for investors and for planners. The time to be aware of higher inflation is not when it happens, but before it happens, ideally, and to prepare for it. And in fact, what we have seen with recent market moves is that, particularly bond markets, is that markets are clearly expecting higher inflation in 2021. However, what does not seem to be factored in quite yet is how long this inflation bout will last and how high inflation can go. I think if you went out and asked people, they would probably say, yes, we'll see a little bit of higher inflation in 2021, maybe reaching up to 2.5–3%, but it will then fall back again. I think that's a very, very optimistic view that is likely to be proven wrong on the basis of very strong output growth, very strong broad money growth, and rising expectations of higher prices. And so inflation in 2021, 2022 could still come as a very nasty surprise. I will stop there. I haven't been able to see anyone watching, but I'm sure you are a marvelous audience, and I'm now at your disposal for questions.